Hi, this is Jim Cunningham, and we're going to talk about the ultimate guide to using LLCs for real estate investing. A lot of common questions in here. We're going to go over a lot of really good high value material and people who build real estate empires, okay, large or small, $100 million portfolio, $1 million portfolio. A lot of people use LLCs. Why don't people use corporations? Why don't people use partnerships as much anymore? Although sometimes you'll see a partnership. But most real estate investing that we see is done in the vehicle of an LLC. I do want to give a little bit of a warning. We're going to cover this. The Corporate Transparency Act is a new reporting requirement. Now, this is if you have an existing LLC, your reporting deadline starts January 1 of 2025, which sounds like a long time from now, but we're in November of 2023, so it's a little bit over a year. If you create a new LLC, starting January 1, 2024, there is reporting that is required to the United States Treasury. So a lot of reporting to the IRS. Now you're going to have to report to Treasury. This is the Financial Crimes Enforcement Network. They're trying to tamp out organized crime, corrupt activity, terrorism, all that stuff. So we're going to go through this in a little bit more in depth. I did want to bring this to your attention. You're going to see this a lot in the news here pretty quick. My name is Jim Cunningham. I'm an attorney at Cunningham Legal. I'm a partner. We have offices throughout California. I have more than 25 years experience. I'm a certified specialist in estate planning, trust, and probate law, also securities and insurance licensed, and a pilot. These are the lawyers in our firm. We serve the kind of the mass affluent of California and other parts of the United States. And we kind of help all things people with wealthy families who want to maintain, sort of preserve and grow multi-generational wealth. If you're watching this on YouTube, go ahead and subscribe to our YouTube channel. This is a great way to stay informed. If you click the bell, you'll be alerted when our content is released, typically around 6 p.m. Pacific time every Thursday. I'm a lawyer. I'm talking. This is not legal advice, okay? There's no attorney-client relationship. When I say you, I'm meaning you generally, not you specifically. So it's very important to understand that this is information only. And, if you're going to do any of the things that we're talking about here, you really should seek competent legal advice. You're welcome to, reach out to our firm. If you already have an attorney, you can reach out to your existing attorney, but please understand this isn't legal advice. So why the limited liability company for real property? Why do people do it? Well, it used to be in the old days, there were only corporations, okay? The only thing you had was a corporation or a partnership. But if you were just one person, a partnership takes two people. So it used to be back in the 1950s, your corporation was the only option. And this is before S Corps. Everything was a C Corp. And then time goes by, and then people found that they wanted an easier mechanism, a flexible mechanism with certain asset protection features. So an LLC really brings together the best of many worlds, specifically for real estate. So if you have an operating company, you might use an LLC, meaning if you have a store and you're selling groceries, you might use an LLC, but you might also use a corporate entity. With real estate, we typically see people using pretty much just the LLCs, not the corporation, to a lesser extent partnership. And we'll talk about that a little bit. So a limited liability company limits inside liability. So this is really important. So if let's say mom buys Greenacre, with an LLC, and a fire starts on her property, Greenacre, and spreads it to 10 other properties, right? Mom potentially is liable to all those 10 people. If that fire starts on mom's property and it's mom's negligence, you're responsible for your own negligence. So an LLC might not really help you in that situation. But if it's not mom's fault, let's say mom's, 1,000 miles away and maybe a tenant or some other person on the property through no fault of mom, right? That fire starts and spreads, potentially she's still liable. So it's very important to understand that this LLC contains the liability to the LLC. So in this case, the property, if it spreads by fire, that liability is contained to the equity that mom has in that LLC. And if it's done right, you can preserve Prop 13 for multiple generations. So we'll talk about how to use an LLC in the purchase of property. So it's important that the LLC itself purchase the property, or when the property is transferred to the LLC, the property is 100% reassessed. And that's the way you can lock in that that sort of almost a perpetual Prop 13. So what is a limited liability company? Well, a limited liability company is a business structure that combines the asset protection features that a corporation has and the tax benefits and flexibility of a partnership. And this can be a very effective tool due to its flexibility, tax advantages, and liability protection. So if you wanted to mimic the benefits of a partnership and limit your liability, what we used to do, before LLCs, is we would have to form a corporation that would be the general partner and own 1%. The limited partnership shares would have the same limited liability, but you have to have a corporate entity plus the partnership. Well, the LLC eliminates this need to have this sort of corporate general partner. And I don't mean to get in the weeds on this, but to understand the LLC is really a simplification of that process and gives you that similar creditor protection. So think of an LLC as Las Vegas. What happens in Vegas stays in Vegas. If mom sued for that fire that starts on her property and spreads to other properties, the idea here is that her liability is limited to her equity position in the LLC. So the most that she can lose is what is in the LLC. It's not going to spill over to her other personal assets. But again, mom's always responsible for her own negligence. So if mom is negligent in starting the fire, she's personally liable based on her own actions. If that fire happens to start on the property spontaneously, let's say, and spreads to other properties, well, that the fire was caused by the fire that started on the property owned by the LLC. And so that LLC is potentially liable for the spread of the fire. So very important to understand. So advantages of an LLC: ease of transfer. There are fewer corporate formalities. With a corporation, you have to have an annual meeting. An LLC, unless it's mandated, right, just natively does not have that annual meeting requirement. So not as many formalities. Flexibility. You have management and ownership flexibility and flexibility in distribution. So something to understand is with a corporate structure, if a shareholder owns 10% and there's a distribution of profits, that shareholder must receive 10%. Now, there are some workarounds in corporations. You can have preferred stock or whatever it is, but on a very high level, if that shareholder owns 10% and there's a distribution to the shareholders, that shareholder is going to get 10%. If it's a partnership and a partner owns 10%, that partner might get a 50% distribution, right? Maybe the partner's contributing more sweat equity, right, to that partnership. So that partnership allows for a little more flexibility in the distributions. And LLCs are great for estate planning for multi-generational wealth. And really, if you think about it, let's say you have multifamily, it's 100 units. You have that in an LLC. If the property's not in an LLC and you pass away and it goes to your 3 kids, well, the 3 of them own the property, right? A third, a third, a third. How does that going to work? Do all 3 have to sign everything? Yeah. So an LLC combines the management into a single entity, a single manager. So it is a little more efficient. Again, liability asset protection. The LLC does provide this sort of inside liability protection, meaning whatever happens in the LLC stays in the LLC, absent your own negligence. And you also have the pass-through taxation and tax benefits, and we'll cover that. But the LLC is not, if it's a partnership structure, it's taxed as a partnership, is not paying tax at the LLC level, right? So it's paid by the individual owners of the LLC units. Now, LLC in real estate, this is, I'm say something kind of obvious. The LLC owns the title to the property, right? So that owns the property. How do we know who owns the property? Well, we go to the local county recorder and the property is in, somebody's name, right? Well, in this case, if the property is owned by the LLC will show as the owner of record on the deed and on the tax bill. So the LLC owns the property, not the individual people who own the LLC shares. So if I have a piece of property and it's in my name and I create an LLC, I sign a deed, and that property now goes into the LLC by deed. In exchange, I'm getting shares or membership units or whatever I decide to call it. Again, LLC is very flexible. I get the 100% of those LLC shares in my name. That does not result in reassessment. This is very important. If I own 100% of the property and I put 100% of the property in the LLC and I get back 100% of shares in exchange for my contribution to the property, no reassessment. If I own the property and I own 99% of the LLC and my son owns 1% of the LLC and I transfer that property into the LLC, the property's fully reassessed. So this is when we talk about Prop 13 compliant LLCs. The lawyer you hire, and you should hire a lawyer when you have real estate and an LLC and you put those 2 together, It's like making a Reese's peanut butter cup, right? Peanut butter and chocolate, when they go together, you really need a lawyer doing that because most people do not want the property reassessed. And many times people inadvertently have a reassessment. So really something to pay attention to. So again, the LLC benefits, flexibility, very flexible. You can have 3 people owning, a third on the LLC, but maybe one person's working harder. Well, they get a bigger share of the profits. That's something that you can do in a way that you can't do as easily with a corporation. Again, lack of corporate formalities. If you don't have that annual meeting every year with your corporation, a potential creditor could pierce the corporate veil, meaning if mom has a piece of property in a corporation, which we do not recommend that property be in a corporation, broadly speaking, but mom would have to have evidence of these annual meetings, right? Every year she's got to have an annual meeting. Otherwise, she's not following the corporate formalities. That means a creditor could potentially come after mom individually for a liability arising from the corporation. Creditor protection, very important. California, every state has LLC laws. A lot of times, if clients are interested in protecting outside liability, meaning if I own shares in an LLC and there's some type of lawsuit in the future, can my creditor take my shares of the LLC? Well, that's a really good question, right? And California is very creditor friendly. So what a lot of people do is they go to states like Wyoming, Nevada, South Dakota. We like Wyoming for a lot of different reasons, but they might use Wyoming to create an LLC because Wyoming has some special, really creditor protection aspects. So limiting the recovery to a charging order. And you can go ahead and Google charging order and see what that, more detailed explanation. But the idea there is if you're a creditor and that creditor comes after my shares of my LLC, the only thing the creditor gets is a tax bill. They don't get any distributions. So that's a charging order. So that's something we've covered in other materials, but know that you can go to a different state for an LLC. Anonymity. Now, I just talked about the Corporate Transparency Act. That is information that is provided to the U.S. Treasury. So anonymity means people, the general public, does not know who owns the shares of the LLC. Now, the government knows, and it's probably not a bad, I don't know, you can say it's a good or a bad idea, but the message I'm trying to give you is that the individual members of the LLC, that is not a matter of public record. Okay, that stays private. Downsides, LLCs do require care and feeding, and you do have state fees and tax filings. And I think a lot of people in California get a little wrapped around their axle on, I don't want to pay the $800 minimum franchise tax. And is there a way I can get out of that? And, we can talk about, are there ways to get around this or not? Here's the problem. If I'm a judge and there's a lawsuit about an LLC and somebody is looking to kind of have some creditor protection on the LLC, and that person is not paid their $800 minimum franchise tax fee to the state, I think that really compromises the creditor protection of an LLC because you're not following the formalities. So I would say you got to just suck it up and pay it. Is an LLC right for you? That's a really good question. So when not to use an LLC, okay? Professionals in California cannot use LLCs. This is physicians, lawyers, accountants, real estate brokers cannot use LLC. An LLC is just baked in the statute. So they must form a professional corporation. Now, again, this differs from state to state, but California does not allow a California lawyer with a California law firm to create a professional LLC. It's got to be a professional corporation. When can you use an LLC? Well, an independent contractor. So many of our clients are independent contractors, and they're the people they work for say, you really should form a corporation. California's got some pretty robust labor laws. So a lot of times these companies will like to see the contractor form an LLC. You can use an LLC. Now, you might be taxed as an S corp. We cover that in other webinars. So, but that's something you'd really want to visit with your CPA on, or us as your lawyer. And it's going to be small businesses and management of personal investments. So this would be like real estate, maybe potentially portfolio income, stocks and bonds, that sort of a thing. If you're creating a dynasty trust, and again, we cover this in other materials, but this is typically going to be taxed as a partnership or what is called a disregarded entity. A partnership files a separate federal income tax return. A disregarded entity is disregarded, I'm going to put that in air quotes, at the federal level, meaning you do not have a federal tax return to file. You put that on your own 1040. state of California still has a tax return you have to file even for a disregarded entity. So very important to understand. Real estate investing. I would say if clients who come to us who are real estate investors use the LLC regularly, that is the sort of the preferred vehicle. Some people will use a limited partnership in certain contexts. That's if you can't use an LLC. Like an insurance company can't own part of an LLC. So you might see a regulatory reason to use a limited partnership. But I would say by and large, what we see in our practice with our clients who are typically individuals, wealthier individuals, they're using the LLC for real estate investing. And we really recommend that you think hard about having that taxed as a partnership. And the reason why is it's nice if there's an examination, which is a technical word for audit. It's nice maybe to have your partnership return audited and not the rest of your 1040. So a client maybe has 10 properties and they're reporting that all on their 1040 on their individual return. You know, it might be better to do a partnership and have all that rental activity reported on a partnership return. Partnership returns, corporate returns are audited significantly less than an individual. It's because you have to file a balance sheet with the return. So there are a lot of reasons why it's better. It can be better to file a separate tax return. But again, you know, that costs money. There's care and feeding, and there, you do need to balance the fees with, you know, the underlying activity. So LLCs, I would say it's recommended for residential of 1 to 4 units. Really, it's the asset protection. For commercial property, I would say if you have a commercial property, this is office, retail, industrial, multifamily, which would be 5 or more units. I think there are frankly too many risks in this multifamily commercial space. I would really urge the client or nudge the client to do an LLC really for asset protection, because you don't know what these tenants are doing in the bill. I mean, hopefully they're doing everything lawfully, right? But you know, you've got somebody manufacturing something, and who knows what could happen. And I think fire is potentially the single biggest you know, concern. Fire, environmental, although there's some special rules on environmental and liability, but fire is the big one we see. And for ranching and farming, it's absolutely essential. Too much dangerous stuff going on in the ranching and farming space. Gives you asset protection, isolates liabilities, provides a mechanism for accounting. You ideally would be filing a partnership return and filing that separate to Form 1065. All right, we have 2 questions we're going to answer here because I think they're important to answer. And we have 2 questions. Felicia asks, please discuss how using the LLC versus the trust for a small mom and pop investors. And Ben asks, can I form a Delaware statutory trust for my real estate properties for a limited liability purpose? All right, here's the answer that you will not find unless you've kind of lived this. All right. Banks, if you are getting debt financing on the properties, something very important to understand. Banks lend to people. An LLC is a person for these purposes, right? It has a taxpayer identification number. It can enter into contracts. It can do all sorts of things. Banks lend to people. Banks lend to LLCs. Banks lend to partnerships. Banks lend to corporations. Banks do not lend to trusts. Let me say that again. Banks do not lend to trusts. Now, you can say, Jim, that's not what happened in my experience. We had a trust and the loan was to the trust. I'm saying on a very high level, banks don't lend to trusts. That's why you see so many LLCs. That's why people who are maybe, if you have an irrevocable trust, maybe you have a dynasty trust that your grandparents set up for you, and you say, gee, we'd like to take some of this money and do some real estate investing. That's why you might set up an LLC, because you might put 50% down and get 50% loan to value. That's going to be in an LLC. Now, the dynasty trust might own the shares of the LLC, but we don't see trusts engaging in business. We see LLCs engaging in business. So I hope that answered your questions. Can trust versus LLC? Some people try and get around this $800 minimum franchise tax requirement in California. The only viable alternative I have seen is the Nevada limited liability limited partnership. I believe you need 2 people though. So if it's a single person and they say, I really don't want to pay that $800 a year minimum franchise tax, you know, you might be stuck on that. Anyway, let's move on. How to use LLCs for real estate investing and keep Prop 13 for your heirs, right? So what we have here is when we are looking at a limited liability company, When real property is 100% reassessed, when an LLC acquires the property, the LLC becomes what is called the original owner. Original owner is very, very, very important for the long term. Instead of the individual human being owning the property, the real estate is 100% owned by the LLC. The human being, or the human beings plural, own the LLC. So let me say this another way. Original owner status gives you a lot of benefits. The only way you're going to get original owner status is by having the property reassessed when the LLC acquires it. Now, for those of you who've had properties for a long time, you say, well, Jim, that stinks. I got a bunch of, Prop 13 properties. They're protected. This won't work for me. Okay, well, that won't work for you in this case. But if you're going to acquire a property, I think it makes sense to acquire it with an LLC because you get this original owner status. The benefit of original owner status is so long as nobody gets, as long as nobody gets more than 50%, and as long as control does not transfer between parties. Okay, so long as everyone stays under 51% or 50% or less, and so long as control does not transfer. Now, control can go away, right? So if I control 100% of this LLC and I die and I leave it to my 3 kids, but I don't give control to anyone because I had 100%, I had control, but when I die, my control died with me. There's no transfer of control. My 3 kids can inherit that LLC property and it's not reassessed. So let me say this again. If nobody gets more than 50% and control does not transfer from the person who has control to people who don't have control, the property is never reassessed. And this is a very, very powerful tool. We see this with clients who had the foresight to acquire a property with an LLC. There's a very long-term play, right? Because under Prop 13, your taxes can only go up 2% a year. Look how much real estate's gone up in the last 5 years. Okay, it's gone up way, way, way up. And those property taxes have only gone up 10%, right? But the properties might have doubled. So you're really saving because the property goes up in value, but you're not being reassessed as it goes up in value. So very, very important. If done properly, you may never have a reassessment on property owned by an LLC if it's an original owner. So LLC provides creditor protection. This is very important. This is for prospective creditors only. This, if a liability is already arised or anything, you have a judgment out there and you try and do something, or your advisors try and do something. There was a case that came out this year. The attorneys were liable for 3 times the amount of the judgment that they were helping this client to evade. So very important. If you already have a liability, you're not going to be getting creditor protection. So what happens when somebody passes away? Okay, something to understand is death is a change in ownership. Why is that important? So death is a change in ownership. Property is reassessed when there is a change in ownership. So if I own a property and I die, I'm in my name, not in an LLC. In my name, I die and my 3 kids inherit it. My death that's the triggering event. That's the change in ownership. That's the date of the change in ownership, even if my kids do nothing. Let's say I die, they get the house, but they don't do anything for 2 years, right? That house is still reassessed. Well, it's reassessed when the assessor is told of my death. So there might be some back taxes and penalties in there, but understand that death is a change in ownership. So LLC, so what happens when somebody dies owning LLC units? Well, I have news for you, and it's covered in the book, Savvy Estate Planning. You can't take it with you, okay? Savvy Estate Planning, what you need to know before you hire the right lawyer. When you die, and depending on your spiritual beliefs, things will happen or won't happen or whatever. I'm not talking about that. When you leave this earth and you pass away, all your stuff stays behind, and this includes your LLC units. So what do we do when somebody passes away? It should be addressed in the operating agreement. Now, a corporation has bylaws, and in our LLC parlance for our purposes here, it is called an operating agreement. So it is the operating agreement of the limited liability company. That operating agreement should contain provisions that say, if a member dies, then what, right? Do the other members have the opportunity to buy back the shares? Do the shares have to go back to the company? I mean, this can be written a lot of different ways. What about new people? If there are 3 partners and one partner dies, maybe the surviving spouse steps in and says, yeah, I'm going to step into the shoes of my deceased spouse. And the other 2 say, well, we liked your deceased spouse, but we really don't want to be business partners with you. That should all be addressed in the operating agreement. Okay, that's where you find it. Now, it's in the operating agreement. We also need to look at the estate planning document. So you should have something in there that addresses this. So there's a buy sell. There might be some type of language on the operating agreement side, but then you might also have language in the estate plan itself. So those shares go to the kids, and it may be that your two partners say, well, we don't want to be partners with the surviving spouse, but we really like your one kid who's been working in the company. And so that's incorporated into the estate plan. So these documents really should be talking to each other. And the point of me mentioning this is you do have your LLC, you do have your operating agreement, you do have your buy sell agreement, you have these arrangements set up, and your estate plan has to talk with that as well. So the operating agreement also can appoint a manager and say how the property is used. This is the type of, this is our game plan. We want these type of, or these classes of tenants. We want manufacturing, or we want services, or whatever it is, but you can lay that out in the operating agreement as well. So let's look at Hal and Wanda. They create HW LLC. Hal and Wanda put money into the LLC, and they get shares in exchange. So Hal and Wanda create an account, create an LLC. They go to the bank, they open an account, and they put money into that account, and they get shares. The LLC, with the money that Hal and Wanda put in exchange for shares, that LLC goes out and buys Greenacre. So in 2050, which is a long time from now, we're in 2023. So, well, maybe not that long. I mean, time does go by fast. Let's say Greenacre goes up to $5.7 million in value, and the taxes, it's taxed as if it were 1.7 million under Prop 13, right? Because over time, the value of the property goes up. Really, I mean, it's a function of inflation, right? It goes up over time. Those property taxes are going up a lot less percentage-wise. So over time, when Hal and Wanda pass away and that property passes to the children, the property taxes stay at about 18,000. They don't go up to 58,000, right? So this is a long-term play. This is about creating and maintaining, preserving, and transferring multi-generational wealth. And this, by the way, is how families get wealthy. You hire the right advisors, you do the right things, you have appropriate care and feeding on your plan, and you create multi-generational wealth. I see it because we get the people, sometimes the third, fourth, fifth generation of wealth, and they've had a good history of advisors, maybe for 100 years the family has, and they've created a significant wealth for their loved ones. So very, very important to pay attention to that. And very important that this is a long-term play with the LLC in terms of buying a property with an LLC and keeping your Prop 13 taxes low. Picking the right agent or broker. Hal and Wanda want to invest in real estate. Who do you pick? I would say there's a fork in the road. You've got residential, and that's typically 1 to 4 units. And then you have everything else. Now, multifamily is technically residential, but I think that falls in a different bucket. When you purchase residential real estate, you typically go with a residential real estate professional. So if you're like a realtor, if you're new to this, if you're like, hey, I want to learn about real estate investing, when you go to invest in a duplex, you're typically going to go through a residential listing. You go on realtor.com, you go on Redfin, you're scoping it out, you're looking around. If you say, gee, I'd really like to buy this 50-unit apartment building, that's in the commercial side, right? Typically, those are going to be your CBRE, your JLL. There's going to be the bigger houses on that. And the reason is you really do need to look at the economics of it, because your loans are typically larger and they're different. They're done differently than residential loans, right? You might get an FHA loan on a residential property. You're not going to get an FHA loan in the same way for a multifamily with 100 units. So just understand that you go with typically a commercial real estate professional. FHA limits, speaking of FHA, currently they are $497,000 to $1,089,000. So it's $1,089,000 in Alameda County and $497,000 in Alpine County. This is what it is. Meaning these are sort of federally subsidized loans. So, and it's up to $2 million on a 4-unit. So if you wanted to get a 4-plex in Alameda County or Oakland or wherever it is, you can get some government-backed loans, right? Because the government really has been following a subsidized housing, sort of a cheap housing policy and a cheap food policy for 100 years. The U.S. government subsidizes the creation of housing, so that on a very high level. That's why we have these FHA loans. But sometimes people choose not to do FHA financing. It can be a little bit higher. And again, as you go to the commercial side, it's just a completely different animal. So here's kind of a hack. If you're new to this, the a little bit of secrets is I would really pump the brakes on waiving the inspection. And I will tell you, I'm a licensed real estate broker. And a lot of times, certainly in a hot housing market, people say, well, waive inspection. I don't think that's a good idea. Now, the reason is on inspection, you can kind of beat up the seller on price a little bit. And if you're a seller, you need to anticipate that if somebody inspects the house, they say, well, there's this problem, that problem, that problem. We want you to come off on your price, or we want a credit in escrow, right? And that can help reduce your down payment. So just a little bit of a hack there. This is you agree on a price, but then you do your physical inspection and you say, I want a little bit of break on the price. So residential real estate, pros in investing in real estate. You can focus on your day job and get passive income. If you buy a condo and there's a tenant in there, you're not doing anything. Ideally, they're paying their rent. Ideally, they're taking care of it. They're not trashing it. And ideally, that rent is used to reduce the principal and give you some tax benefits. Okay. Interest paid is tax deductible. That's very important to know. All interest paid on rentals, so there's no cap. And you can use a self-directed IRA to invest in real estate. That's a topic for another day. Often, I would say real estate has less volatility than the stock market. It's because that price is not flashed in front of your face. Now, real estate can be volatile, but Apple's up 10%, Apple's down 10%. You're not going to get the same reporting on residential. You're just not going to see it. I mean, you can go on Zillow and Redfin to see what they think it's worth, but it tends to be a little bit more even keel than stocks and bonds. Cons are tenants can be a pain in the neck. So if you're looking to invest in real estate, just because you have an LLC doesn't solve all problems. They can be a real pain in the neck. And hiring a property manager can be expensive. We see statistically people use property managers for residential real estate about 20% of the time. There are high entry and exit costs. So this was just recently in the news about how, we had a couple of big companies sued and they're ordered to pay, I don't know, $5 billion because of the way, properties are sold and the way commissions are paid. So, but again, 5 or 6% commission, 4, 5, 6% commission, that's a pretty steep commission, buying on the buy and the sell side. So someone's got to pay that. And it's typically coming out of your return. And then the other one is, will the rent cover the payment? So we're going through a higher real estate or higher inflation, going through a higher interest rate cycle. And then you really need to look at this, does this negative cash flow, which means, you're getting $2,000 in rent and your $2,500 a month is $2,500 of the month is going out. That is $500 a month negative cash flow. That's not a good thing. Can you support that? Does it make sense for you? If the property's economically vacant. Now, what does economically vacant mean? It means somebody's in the property, but they're not paying their rent. Yeah, that never happens, right? You still need to pay the taxes and maintain the property, and you need to make the payment, even if your tenant is not paying you rent, which if you're a real estate investor, sometimes does happen. Properties are not always quickly and easily sold. Stock market, you can just pick up the phone or whatever, go online, sell the stock, done. That's a capital market. Real estate does not function in the same way. You have to find a buyer, you got to sell it, go through an escrow process. So it's not as quickly. And then rent control. So there is statewide rent control in California, as well as other municipalities. So I would say that real estate, this is the way I think of real estate in coastal urban California. These have low capitalization rates. So you'll hear this more on the commercials and multifamily side, and to a lesser extent on the residential. What is a capitalization rate? Well, a capitalization rate takes your net operating income. So your income divided by the value of the property. So the higher the percentage, the higher the cap rate, kind of the better. If you have $1 million property and you're getting or if you have a $10 million property and you're getting $300,000 in income, that's a cap rate of 3%. If you have a $5 million property and getting $150,000 in income, that's 3%. So it's the same percent. But if you have a $10 million property and you're getting $1 million in income, that's better than $300,000 in income. That's a 10% cap rate. So it's the higher the cap rate, the more income you're getting based on the value of the property. So we have Laker Acre in Los Angeles, has the market value of 10 million and operating income of 300,000. Again, that's 3% cap rate. And then Warrior Acre in San Francisco, I couldn't resist. Smaller number, but same cap rate. So I want you to understand that this is a percentage return based on the asset, not necessarily a number itself. And I would say in coastal California, the properties are more like works of art, frankly. They're stores of value. They're rather than cash flow machines. You could go to Oklahoma and you might get 8% cap rate. Now, you're probably not going to get capital appreciation, but if you own a home in Mountain View or you own a home in Pacific Palisades, those don't really go down. I mean, they do go down as markets go up and down, but I would say over time, those are highly desirable areas. And these are areas that we just see historically hold their value. So commercial real estate, pros, income, professional relationships. You're dealing with professionals ideally. Owners typically are not individuals. In the commercial real estate space, we see LLCs owning the properties, no rent control. This is a biggie. So there's no rent control on the commercial space. Office is going through a weird phase right now. But one of the pros on commercial property is tenants maintain the properties, okay? And they tend to maintain them better than, largely speaking, those commercial tenants likely will have maintained them better than someone's house, right? Because they're running a business. They've got to keep it clean. They've got to keep, they got to keep the thing functioning so people can come in and buy stuff. Limited hours of operation. So they're typically not open 24/7. A lot of times these are business hours, and no leaky faucets or plugged toilets you have to deal with. A lot of times there is a management team or maintenance team or whatever it might be. So you're not having to deal with stuff on Super Bowl Sunday. More objective price valuation. So on the commercial space, we do see a heavy emphasis on cap rate. They're looking at cap rate, vacancy. They're looking at a whole host of economic factors, more so than you would potentially like buying a single family home in Los Angeles, right? I think there's a little bit more price transparency on the commercial properties, because you can get the financials on the tenant. All right. So if you're going to buy a property, you can get a lot more data potentially than you can if you're buying, a duplex on who your tenants are. Triple net lease means that you lease the property and the tenant takes care of everything. They're paying the taxes, the maintenance, the insurance, the whole 9 yards. Okay. You can have more flexibility in commercial lease terms and fewer consumer protection laws. That's very, very important. Security deposit termination rules. Residential is heavily regulated. Con is typically a bigger investment dollar. So if you're going to buy that strip mall, typically it's a bigger number that you're having to come up with, and it can be more capital up front. So you might have a vacancy, you might have to do build outs, tenant improvements. So you might have to be digging into your pocket. And there are more potential liability. So if you have a commercial property, people are coming and going when the business is open, potential liability, you really want to look at an LLC on that one. You wouldn't want to be relying solely on, insurance or whatever it might be. Most of the time, these properties are owned by an LLC. And there is a level of time commitment. You do need to pay attention to it on commercial. I would say residential, probably, on a high level, potentially less of a time commitment. And you're dealing with multiple leases. If you have a property with multiple tenants, common area maintenance adjustments. So you have to figure out how much we got the parking lot repaved. You're going to have to calculate that and maybe pass that through to the tenants. And liability, you got to watch your liability. You got a lot of people coming and going. These can be slower than residential to get leased out. That's very important. These properties, I mean, look at office right now, stuff sitting vacant. Someone's got to pay the mortgage. Someone's got to pay the maintenance. So we covered this briefly, the drop and swap in California. Hal and Paul own HP LLC, which in turn owns Red Acre. Hal and Paul want to split the sheets, go their separate ways, and do a 1031 exchange. Now, we covered this in other materials. It's a way of selling property and buying a replacement property and deferring the taxes. If Hal and Paul transfer Red Acre to Hal and Paul as tenants in common or joint tenants, and then Hal and Paul do their own respective 1031 exchanges, California will likely consider this a drop and swap and deny the 1031 exchange for California purposes, right? And subject Hal and Paul to California income tax. So California has no capital gains tax. It's all income tax. I really would pay attention to this. If you do have property in an LLC with somebody else, you're really going to want to talk to an expert. Certainly in our firm, we can help you with that. But you really want to talk to someone who knows this, because you can't just take this property out and then immediately turn around and do a tax deferred exchange. LLCs can be taxed differently. So LLC taxation options. Disregarded entity means it's just you. A single person, a single member LLC is many times a disregarded entity. There's no federal income tax return. It's reported on your 1040. You still have a gross receipts tax in California, that $800 minimum franchise tax. It is the simplest tax structure. Is it the best? I will tell you, as time goes by, I'm looking more and more at the partnership. Now, it does take two people. Potentially, you could do a partnership with your living trust at 99% and you as 1%. That's potentially, but it does require a Form 1065, and that's going to cost a few $1,000s a year at least. Okay, so just something to be aware of. It's very common for real estate to be owned in a partnership. Very common for the LLC to be taxed as a partnership. It is in fact the default way to tax a partnership, or tax an LLC is as a partnership. Then you have the LLC. You can opt into being taxed as a corporation. An S corporation, everything flows through the S to the shareholder. This does require a Form 1120, and there's no federal corporate tax. California does charge a 1.5% tax on corporate profits. And then a C corp, an LLC tax is a C corp. We don't really see a whole lot, but you're paying tax at two levels, at the corporate level and then when you make a distribution. So what about the gross receipts tax? In most cases, LLCs, most cases we see, they're not paying income and capital gains taxes. It's the individual holder, right, of the LLC units, because it passes through the members. And the gross receipts taxes are capped at $11,790. So if you have a vacant lot and you're sitting on it and it's a $5 million lot and there's no income, it's $900 a year or $800 a year minimum franchise tax. Once you hit 250,000 in gross receipts, it kicks it up $100. But really, if you're doing 5 million in gross receipts and you have to pay 11,000 on an LLC, unless your cost of goods is 4.9 million, it is what it is, right? And the alternative is to pay maybe that 1.5% S corp tax. So you kind of have to look at the two, and that can drive your choice of entity. The care and feeding required for your business entity, I would say that you typically need a lawyer, a CPA, and a financial advisor. All those people working together. And also the Corporate Transparency Act, which we're going to cover here in a little bit, for all new LLCs, that begins January 1, 2024. And this is very, very important. You should pay close attention to this. And in 2025, it applies to all LLCs. So the Corporate Transparency Act, very, very important, extra layer of reporting. This is a really scary logo because it's a bald eagle with no olive branches. It's just claws and a bunch of O's and ones on this seal. If you look at it, it's like the whole world and the government is really clamping down on, frankly, money laundering, tax fraud, and other corrupt activity, terrorism, whatever it is. The government is really taking a pretty bold approach on this. And in my 30 years of practicing law, I've never seen anything like this. Okay. It's a new level of reporting. We already report to the IRS, but now you're having to report to Treasury. It's a different agency. Well, it's the same. It's within Treasury, but they're asking for this information. And this is a new thing that they're asking for. It's not reported on the tax returns, but this is a direct reporting to Treasury. So who's required to report under the Corporate Transparency Act? All reporting is very important. There are 23 exemptions or exceptions to a reporting company, but if you're required to report, it includes all domestic and foreign companies registered to do business anywhere in the United States. Got to report. Any corporation, LLC, partnership, general partnership, limited partnership, and limited liability partnership, business trust. So we had some earlier questions about, hey, can I do a business trust, like a Delaware statutory trust or Massachusetts business trust? Going to have to report. Or any other domestic or foreign entity formed or registered under the United States or any state or tribe and has at least one beneficial owner. Now, there are 23 exceptions to this. 19 of them are government financial services and accounting. So if you're a broker dealer, if you're, these people are already so heavily covered by anti-money laundering, I think they did a blanket exemption. If you are a large operating company, which means more than 20 full-time U.S. employees, this excludes employees of affiliated entities, so you cannot aggregate employees. So if you have 20 full-time employees and $5 million in revenue from the prior year and have an operating presence at a physical location in the United States, which means, an office, a warehouse, something like that, then you're exempt, okay? And subsidiaries that are wholly owned are also exempt. So pretty large exemption, but look at this. If you own real estate in an LLC, you may not have any employees. Boom. So now you're a reporting company. So if you have an LLC that owns real estate, Remember, if you have an LLC right now, that reporting starts January 1, 2025. If you create a new entity in 2024, it's due within 30 days. If you have an inactive entity, I set up that LLC 15 years ago, I haven't done anything with it. If it was created before January 1, or January 1, 2020 or earlier, and not engaged in business activity and not owned by a foreigner, and there's no change in ownership in the preceding 2 months, and you haven't done more than 1,000 in business, right? Then you are inactive. So you don't have that reporting requirement. So what information, what, how, who, and when? These are the kind of questions. Companies must submit company, which means if it's an LLC, probably the manager. Companies must submit a beneficial ownership information report to the U.S. Treasury's Financial Crimes and Enforcement Network, or FinCEN, containing the full name, date of birth, current residential address, no P.O. box, and passport number or other government-issued identification number. So pretty big, right? And a beneficial owner is anyone who exercises control or owns a 25% stake or more in a company. So if you own 20, looks like you're not considered a beneficial owner. So it's important to kind of look through. You're gonna have to comb through and figure out who's reported and when, or what the requirements are. And this has to be reported within 30 days of any change in beneficial ownership information. And again, existing entities formed January 1, 2024 or later fall under this 30-day window. If it's an existing LLC, you're going to have to report within 30 days of January 1, 2025. And you go through FinCEN on their secure online portal. Now, what if you willfully provide false information, or fail to provide complete information, or fail to update information? You're subject to fine and potentially imprisonment. So companies that fail to comply with the Corporate Transparency Act's reporting requirements are subject to civil penalties up to $500 per day to a maximum $10 million. This is a big deal. This is a big fine, up to 2 years in prison. So it's very important. If you have an LLC, you need to pay attention to it. These are some resources that you can go to. This is the FinCEN's website. You're going to hear a lot about this in the news, probably in December. Certainly toward the end of next year, you're going to hear a lot about it. But it's something that the Congress passed, the president signed, and we're just going to have to deal with it. Use of Prop 13 compliant LLCs to hold real property. So what are we talking about? So we talked about purchasing an property with an LLC. So when you're buying that property, create the LLC, buy the property with the LLC, and many times the reassessment can be avoided if done properly. So Hal and Wanda, again, they buy this property. Hal and Wanda buy this LLC. They buy a vacation home for $1 million and rent it out for short-term rentals via Airbnb. Now the home's worth $3 million. When the 3 kids inherit the home, each acquires a 1/3 interest. No change in ownership, right? No one kid is in control. They each own a third. They get, 2 have to get together to do anything, right? You need, 2 out of 3 votes. The property must be acquired by the LLC, not transferred after purchase unless it's reassessed when it goes into the LLC. And, another one is maybe son can get 49%, daughter-in-law can get 49%, the grandkids get the other 2. So a lot of different ways to slice and dice this. And beware of the step transaction doctrine. So this is really important. The step transaction doctrine is a judicial doctrine. It's not a law. And what it says is if you do a series of separate steps just to evade taxes, everything gets compressed into one transaction. So I will say people try and game the system with LLCs. So if they say, gee, Jim, I don't have original owner status. I have a big real estate portfolio. Can't I use an LLC to avoid reassessment on the properties? So here's what some people do. And I will say that this is an example of a step transaction doctrine. This is a negative example. This is an example that results in reassessment. So Hal owns Lake House, right? Hal owns this lake house, lakefront house. At 9 a.m., Hal transfers by deed Lake House to Lake House LLC, and he gives 50% to his son. When you transfer 50% or less of an LLC, that is not a change in ownership. So when Hal putting the property into the LLC, he transfers the 50% of the shares to his son right away. That is not a change in ownership. Hal and son then transfer the property from the LLC to Hal and son 50-50. Now, when property goes into an LLC or comes out of an LLC, and the owners inside the LLC are the same as the owners outside of the LLC in the same proportion, in this case 50-50, that is not considered a change in ownership. There's no reassessment. So at 901, Hal and Son transfer the property from the LLC to Hal and Son, each owning 50%. Hal and Son then transfer Lake House to the LLC, and Hal gives 50% to his daughter 1 minute later. So now son and daughter own Lake House 50-50. And the assessor will likely say, not so fast, Hal. You did this solely to avoid taxes. So this is an example of a step transaction. Now, you might hear people or see people out on the internet saying, oh, you can do all this with LLCs. If you do it in this way, in this sequence, within that time frame, that will likely be deemed a step transaction and collapsed and the property reassessed. So let's look at a holding company structure. So what we're talking about here are advanced strategies. So let's look at some advanced strategies. Holding company. So this is kind of taking it up a notch, right? We talked about having an LLC own the real estate. Well, what if there are 3 properties and each LLC owns a property? Well, who owns the shares of the LLC? Well, maybe a holding company does, right? And maybe and the parents give away 99% into a dynasty trust. Maybe they use up some of that $12,920,000 exemption that's getting cut in half in 2 years, right? So they keep 1%, they transfer 99%, and they continue to manage the portfolio properties, right? Kind of makes sense. They're in control. They've transferred ownership to the kids. Like, it's out of mom and dad's estate, right? And now that grows on the kids' side of the ledger in the dynasty trust, and potentially might not be taxed, not property taxes, but might not be taxed for death taxes for 365 years. Maybe they chose Nevada. South Dakota, I think South Dakota is 1,000 years. There's some jurisdictions who have eliminated the length of time that trust could exist in perpetuity. So this is a way of carving out some wealth, setting it aside, and it is never taxed again. I mean, for all intents and purposes, there's no more death tax on that ever. So just setting aside property taxes, but this is a way to create multi-generational wealth. So Hal and Wanda own, so this is the use case if you have a business and you own the property and you're conducting the business at the property. So Hal and Wanda own McDonald's at 123 Main Street. And they can just own the property. They can own the McDonald's in their individual name. They can own the property in their individual name. All right. And they can do that. The problem is they do not have limited liability. So they have an operating company, so this operating McDonald's, and then the dirt that the McDonald's is on. So what we typically see is the Hal and Wanda would create a corporation or an LLC taxed as a corporation, but Hal and Wanda create an S corporation to run the business. Now, there are a lot of reasons why you would use an S corporation for an operating business that are kind of outside of the scope of what we're talking about here. But Hal and Wanda, now they also own the property. So they would own that property in an LLC, typically taxed as a partnership, so that Hal and Wanda have an operating business that leases the property from the partnership. Now, what this does is this isolates liability. So you have the liability employing people coming in and out. You don't want someone slipping on a French fry and suing you. So you want to have that S corp liability, all those liabilities contained in that one entity. And you don't want the real property inside of the same operating entity, because then the creditor could come after everything. So you want to separate the operation of the business, and you want to separate the liability of the operation of the business from the underlying asset, which is the dirt, which is the real estate, which, I mean, it's just kind of sitting there, and the operating business is renting it. So that is how this structure works. So when either Hal or Wanda dies, they're in California, they get an adjusted cost basis on the land, a full adjusted cost basis, because it's community property. And again, we talk about that in other webinars. So the S corp owns and is running the McDonald's. The partnership owns the land, and by this structure, they save about $120,000 in taxes total. All right, and there are a lot of reasons why, but understand that they get liability protection and they pay less tax by having this structure. So it's beneficial for them. So the bottom line is you need to find an expert and seek advice. And the advice likely is, if you're buying real estate, consider an LLC. Now, I say consider because it may be appropriate. It may not be appropriate. You may have an LLC already that you're not using. You're like, well, can I use that LLC? Yeah, you might need an operating agreement for that. That doesn't mess you up with Prop 13. Very, very important. You don't need an operating agreement to have an LLC. If you transfer property to an LLC, the assessor will ask at least for the schedule of members. They want to know who are the owners of that LLC. Because if I own a piece of property and I put it in the LLC, if I don't own 100% of those shares of the LLC, that property is going to get reassessed. And if I transfer the property to the assessor and they say, gee, I want to see your schedule of members, and I ignore them, that property is going to get reassessed. Okay. Because I have to, it's incumbent upon me to prove that I am the member on the schedule of members and nobody else. So make sure the LLC is Prop 13 compliant, which is kind of this proportional ownership that we're talking about, and also follow the advice and all the rules. You know, people who try and skirt the rules or they try and find a shortcut oftentimes end up very unhappy because they did not follow the rules, and there are bad consequences. So how do you start? You can contact us. We hold an initial consult to see which strategy is best, and we can set up the entities for you and prepare the required documents and set up the appropriate structures. And but you're probably curious, how do you form an LLC? Okay. It is done state by state, and it's a matter of contract law. So the operating agreement falls under contract law, and LLCs have lots of flexibility. So is it enough to consult with a lawyer? Maybe, but a CPA, financial advisor, often are involved in that process. And if your assets are over 10 million, our firm has multifamily office services, which is kind of an ongoing relationship with clients where we're monitoring things and making sure all I's are dotted and T's are crossed, and that the wealth creation and preservation is maximized and taxes are minimized. And also the book Savvy Estate Planning covers many of the things we've talked about here on the basics of estate planning. And we have offices in Northern and Southern California, Bay Area, Capital Region, as well as the LA area. And next week, November 16th, we have Art Antiques and the IRS, a crash course on estate planning and collectibles. Many of our clients have very valuable collectibles, not so valuable collectibles, but it's a little bit of the, not so much Antiques Roadshow, but we're going to look into art, antiques, and the like, and some good stories there. We've got a special guest from the Roth Art Group who's going to be presenting with us, and I'm really looking forward to that. Subscribe to our YouTube channel if you're watching this on YouTube, and if you've never gone to our YouTube channel, please go right now and subscribe and hit the little bell button, and we will answer some questions. If you are watching this on YouTube, right, just keep watching, because another video is going to magically roll after this one